We have seen gold gain tremendous value in a relatively short period of time without geopolitical issues coming into the mix. In other words, people are talking about the economy, about what the Federal Reserve does, and we're not so focused on the war in Ukraine and the issues in the Middle East anymore. Those have kind of moved to the back seat, and everybody's focused on what the Federal Reserve is going to do. And so I do believe that my most optimistic model is looking for gold to test $2,700 by the end of this year, first quarter of next year.
The gold market is experiencing a moment of recalibration after a meteoric rise to record highs. The precious metals price has retreated to nearly $2,400 in Friday's American session, marking its third consecutive day of decline from the all-time high above $2,480 reached on Tuesday. This pullback comes amidst a strengthening U.S. dollar and rising bond yields, fueled partly by speculation of a Republican victory in the upcoming U.S. presidential elections. Despite the current dip, the overall sentiment for gold remains bullish. GaryWagner, a seasoned financial analyst specializing in precious metals, points to the Federal Reserve's signals of potential interest rate cuts as a key driver. This shift in monetary policy is generally favorable for gold prices, Wagner notes, highlighting that investors have long anticipated the beginning of interest rate normalization. J.P. Morgan shares this optimistic outlook, projecting an average gold price of $2,500 in Q4 2024. Gregory Shearer, head of the firm's base and precious metals strategy, expressed surprise at the timing and intensity of the recent rally, especially given the concurrent repricing of Fed rate cut expectations and rising U.S. real yields. Wagner's analysis suggests a shift in market dynamics, with gold now reacting positively to lower inflation expectations rather than higher ones. This change reflects investors' evolving stance on monetary policy and inflation trends. The market's current pricing indicates a growing conviction that the Federal Reserve will initiate rate cuts in September, with expectations of 2 additional reductions by year-end. Despite the short-term correction, this anticipated policy shift continues to underpin gold's attractiveness. Please tune in for our exploration of GaryWagner's expert analysis. Don't miss out on future content. Hit the subscribe button and turn on notifications to stay in the loop. We appreciate your support.
I think that the fact that they're talking about interest rate cuts and given some idea of the timing of that first cut, as I said, signals the beginning of interest rate normalization. And now it is becoming very, very roughly matched to the last dot plot that was anticipating 2 rate cuts this year, 3 the following year, and I believe 3 in 2026. Prior to that, in March, the dot plot was looking for 3 rate cuts this year. And so that diminished because the data did not back it. And multiple times, Powell, along with other Fed members, said we need greater confidence. We need more data. This time he said we're actually getting the data that we had hoped to get to give us that confidence. And so it's a huge change in the word track that Powell is using. And all of his statements are slightly veiled. He doesn't want to give away too much, but this time he definitely changed his basic outlook to say that, look, we're ready to go. He had a daily candlestick chart of gold, and if it starts really about the middle of February when gold was sitting at around 2,000, and then you can see where my pointer is right now. In the middle of April, it hit the first of 3 all-time record closes, this one coming in at roughly 39. It then retraces and then moves to the second of, and the market's moving so fast, the second occurrence, and this one came in at 2460. It then retraces back down to about 2300, and then this last rally is really from 2300 up to 2488. And what you see is a basic Fibonacci retracement of the data set from 23 to 2488. Now, gold right now has sold off for 2 days, and that's these red candles here, and it's very close to a 23.6% fib retracement. That's an acceptable but shallow correction. A deeper correction would be the 38.2% fib retracement. That comes in at around 2420. And my sense is, all things being equal, if gold continues to decline, we're getting a correction here. And I believe that this, as long as it doesn't fall out of bed, meaning break below 2,400, I believe that it's still exceedingly bullish, because we had a tremendous move of $188 from 2,300 to 2,488. If it comes down to 2,420, it will then recycle and move back into a rally mode, which has to, if we're looking at gold trading with higher highs and higher lows, which is what we've seen recently, then we would expect gold to trade much higher and actually challenge 2,500 per ounce. And that's what we're seeing here. It would go higher from here under the assumption, first, we have political uncertainty, we have geopolitical uncertainty, and we've got a very, very strong possibility that there's going to be, whether it's political or geopolitical issues that come up in the future. So why would gold continue to go up? I think it's because market participants have been waiting so long for interest rate normalization. We're getting gold reacting to lower moves in inflation rather than higher moves. And I think that the trend is higher because what we're going to see is the dollar weaken. I think that that's going to be a big component, is that we could have a extended period of time of dollar weakness. And of course, there's an inverse relationship between gold moving up and the dollar moving down.
As gold prices continue to capture market attention, recent analyses offer a range of forecasts for the remainder of 2024. A prominent analyst, GaryWagner, suggests that even if gold experiences a temporary correction to around $2,420 per ounce, it is likely to rebound and challenge the $2,500 mark. Wagner's optimistic model anticipates that if this correction aligns with a 38.2% Fibonacci retracement and follows an Elliott wave pattern, gold could reach $2,700 by year-end. This perspective aligns with broader market trends observed by the London Bullion Market Association, an independent authority on precious metals. According to the LBMA, analysts predict that gold prices could trade even higher in the latter half of the year, following a record high of $2,480 per ounce on July 17th. The average of various forecasts suggests that gold might reach approximately $2,547 per ounce. However, projections also indicate that the price could average lower by the end of the year, around $2,395 per ounce. Among the more optimistic predictions, some analysts foresee gold prices climbing to $2,650 per ounce in the year's second half. Conversely, the most conservative forecasts predict a potential drop to $1,985 per ounce. Let's get back to the interview.
I think that we already have those steps kind of set in. In other words, if the Fed actually does cut rates in September, which most analysts believe is a high level of probability, then that's signaling a series of cuts. I believe that we'll see 2 rate cuts this year. And with each rate cut, we're getting that upward momentum in gold. What is happening is, one, you still have central banks continuing to buy at record levels, okay? You have different hedge funds as well as speculative funds entering into the market. So you've got a lot of activity by central banks and by large institutional traders kind of jumping on the bandwagon, creating that upward momentum. And when you have that much volume kind of weighted to the buy side, it's going to move gold prices higher. It would have to break below $2,400 per ounce. $2,400 was resistance up until just recently. Once it broke above that price point, it really shot up over the period of about the last week in trading. And from that point, resistance became support. And so as long as that support level holds, I would be exceedingly bullish. And the only real target is to take out the previous all-time record close, which came in at about 2460. and the all-time intraday high, which was 24.88. So that's what, $12 away from 2,500. It's not that far. And I don't think that it is a big stretch to look for gold to at least challenge 2,500. Now, if gold challenges it the way it challenged 2,400, we would expect to see a couple moves above it, only to fail. In other words, it would trade, maybe go to 25.10, 25.12, and then come back down. In the case of 2,400, it took 3 attempts before 2,400 became support rather than resistance. If gold corrects here and moves back to, say, as I said, 24.20, I believe that it will then enter a bullish rally cycle, taking it back to challenge 2,500. Now, in terms of where it could go, and this is one of many possible models, there are a few models that I'm looking at, and obviously this is quite optimistic, but this is assuming that what we're witnessing with this recent high near 2,500, if we have a correction that goes to about 24.20, it's a 38.2% fib retracement. Typically, if we're looking at an Elliott wave count, one is very difficult to ascertain in terms of where it's going to move to. It's called a benchmark wave. But once one is in place, then we use that to ascertain what wave 3 and 5 will do. And what I've done is basically a 1.618 extension of the move that we saw in wave 1 to wave 3, and that would take gold to about $2,700. And I think that that is very optimistic. It's very bullish, but it's also probable. And I wouldn't have said that at the beginning of the year. In other words, you have to look at what's happened over this last year. And we have seen gold gain tremendous value in a relatively short period of time without geopolitical issues coming into the mix. In other words, people are talking about the economy, about what the Federal Reserve does, and we're not so focused on the war in Ukraine and the issues in the Middle East anymore. Those have kind of moved to the back seat, and everybody's focused on what the Federal Reserve is going to do. And so I do believe that my most optimistic model is looking for gold to test $2,700 by the end of this year, first quarter of next year.
Will the anticipated Federal Reserve rate cuts and evolving inflation expectations be enough to sustain gold's bullish momentum? Or might other factors influence its trajectory? Share your perspective in the comment section. If the video resonates with you, join our community by subscribing to our channel and enabling notifications with the bell icon. Thank you for being a part of our community.